There's a few ugly truths that no one ever tells you about business credit. If you don't learn this, it will leave you banging your head against the wall, wanting to quit before you even get started. We gotta talk about why net 30 accounts are a waste of time sometimes, the shady practice banks use that keeps people in the dark on their approval odds, and why the best time to get business funding is when you don't need it. And you know another thing you don't need? It's hard credit pulls. Nobody needs those. So don't forget, I'll leave a link below to my No PG business card master list where strong business owners can apply and get approved for business cards with no hard credit pull whatsoever. So just hit the link below to check that out. The first thing you gotta know is that banks change their criteria often. They have what they call dynamic lending policies where they're always moving the goalposts. So moving on, here's something most people don't realize about banks. Their lending criteria aren't written in stone. They're more like shifting sands. One day you meet their requirements and the next it's like the rules have changed without warning. Banks are constantly adjusting their criteria based on things that you can't always see, like market conditions, the economy, or even their internal goals. So why do banks change their lending policies? I'll explain it like this. Imagine a bank like a living organism. It reacts to its environment. During economic downturns, think back to early this year, everything tightened up. Banks suddenly wanted to see more paperwork, higher credit scores, and more solid revenue numbers. It wasn't because they didn't want to lend, it's because they wanted to lend safely. On the flip side, when the economy is strong and banks are chasing growth, they might lower their standards. Suddenly that no doc loan might be available, or a smaller business might qualify for funding that was off limits just months earlier. Banks keep you on your toes by constantly adjusting their criteria in ways that aren't always obvious. One week they may favor funding retail businesses, and the next they shift focus to tech startups, leaving industries they consider risky like restaurants with fewer options. They also frequently change when they require documentation for loans or credit lines. For example, they might quietly lower the revenue threshold that triggers income verification, suddenly requiring more paperwork for what seemed like a straightforward application. Even which bureau they pull from can vary. One applicant might face a soft pull from Experian, while another experiences a dual pull from Experian and TransUnion. Lastly, minimum credit score requirements can shift over time. Amex, for instance, has gradually increased its minimum score for business credit lines from 620 to 660, a trend you'd miss if you're not closely monitoring changes. These subtle shifts make it critical to stay informed and adaptable when seeking funding. Now here's the thing, you need one of three things to secure business credit. And let's be honest, there's a lot of noise out there about getting business credit without a personal guarantee. It's really the shiny promise that lures people in. No credit check, no documents, instant approval. But the truth? That's mostly a myth for most people. If you're serious about building business credit, you need to come to the table with at least one of these three things. You need strong credit, or significant cash flow, or valuable collateral. It's the 3 C's: cash, credit, and collateral. For credit, many lenders, including heavy hitters like Chase and Amex, look at your personal credit score before they give you business credit. Now imagine you're lending someone money. If they've been careless with their own finances, will you really trust them with yours? Probably not. And here's just a few data points out of more than 20 that banks typically look for. They want a FICO score of 700 or higher. They want low utilization. Think about it this way. If you're maxing out your cards, lenders see you as someone who might be struggling to manage your expenses. Keep it below 10%, or even better, 5%. Then they want a clean history, no late payments, no collections, no surprises. A spotless report shows you've been on top of your game. The hard truth is, people often think they can skip this step by going straight to EIN only credit. But here's a spoiler, even those programs sometimes take a look at your personal credit during the decision process. Plus, I'd argue that fixing your personal credit is a lot easier than building a profitable business. Then the banks are looking at cash. If your personal credit isn't where you want it to be, your next best bet is proving your business is a cash generating machine. Yes, EIN only credit exists, but here's the catch. It's mostly for businesses with serious revenue and stable cash flow. High revenue is king. For example, traditional lenders may cater to businesses making $10 million plus annually to skip personal guarantees. Then you got fintech solutions for smaller revenue companies. The new kids on the block like Revolut and Ramp are shaking things up. Revolut offers business cards and flex lines to businesses generating just $20,000 per month in sales. And then Ramp considers total deposits of $50,000 in your business bank account. And here's the documentation that you'll need. And lenders want to see proof, so be ready with these documents. You'll need bank statements to show steady deposits over time. This actually includes linking your business checking account using Plaid as well. You might also need profit and loss statements. That's going to demonstrate you're managing your revenue wisely. And you might need tax returns. Back up your claims with government verified numbers. Now, if your business has healthy revenue, you can bypass the credit conversation entirely with some lenders. It's about showing your business can stand on its own 2 feet. And the third option you have is collateral. This is often overlooked. Most people don't talk about using collateral. It's not as flashy as a high credit score or big revenue, but it can be just as powerful. Think of collateral as a safety net for the lender. You can use vehicles. If you got a fleet of work trucks or delivery vans, that's leverage. You can use equipment, whether it's construction machinery or office computers, assets can work in your favor. And you got real estate, a commercial building or office space can seal the deal too. Now here's the deal. Lenders reduce their risk by attaching a lien to your asset. If you default, they seize and sell the collateral to recover the money. Now I know that sounds harsh, but it opens doors for funding you might not get otherwise. If this is your strategy, here's what you need. You need clear ownership documentation to prove the assets are yours. You might need a professional valuation. Some lenders require an appraisal to verify its worth. And then you need what's called unencumbered collateral. Make sure the asset isn't already tied to another loan. So if you've ever spent any time researching business credit, you've probably heard about the so-called tier system. It goes something like this. You start with the tier 1 net 30 accounts, then you graduate to tier 2 net 60 or net 90 accounts, and eventually you unlock the holy grail of business credit cards and lines of credit. That sounds simple, right? Well, here's the truth. It's really a myth. You don't need to crawl up this ladder to access business credit cards, and those net 30 accounts aren't the key to unlocking major funding. Net 30 accounts are like store credit cards. They're only useful within a specific vendor's ecosystem. Let's say you need office supplies. Great. You've got a net 30 with Staples, but try buying inventory or paying for advertising with that account, and you're out of luck. The beauty of business credit cards is that many don't require you to build a lengthy credit history with net 30s. Instead, they often rely on your personal credit. That means a strong personal credit profile can open doors to business credit cards right out of the gate. They rely on your business profile. Even a newly registered LLC or sole proprietorship with an EIN can be enough for many business cards, especially if your personal credit score is solid. I've seen entrepreneurs skip the tier process entirely and land high limit business cards within months of forming their business. One person I analyzed opened a Chase Inc. business preferred card for $20,000 within 20 days of registering their LLC. They didn't even touch a net 30 account. If your business isn't profitable or at least showing real potential, think of business credit as fuel. If your car is already broken, adding more gas won't fix the engine. It'll just spill everywhere and waste resources. Loans aren't lifesavers. Borrowing to save a struggling business often creates a cycle of financial strain. High interest rates, strict repayment terms, and a lack of immediate revenue can quickly lead to default. You want to borrow to build, not to bail out. Business credit should be reserved for expanding something that's already working, like increasing inventory, hiring more staff to meet growing demand, or scaling operations. I remember a client came to me eager to secure business funding. Their enthusiasm was undeniable. They had big dreams and a plan to buy a business after taking a few courses. But as we unpacked their situation, a stark reality emerged. They had no business revenue, no concrete plan, and no results to show. It was like trying to bake a cake without a recipe or ingredients or even oven. They wanted the funding before they had the basic business in place. Business funding isn't designed to create success from thin air. It's a multiplier for what's already working, not a starter kit. Borrowing money to figure things out as you go is a fast track to financial destruction, not growth. If you're ready to chase your entrepreneurial dreams, focus on building your foundation first. Validate your idea, create a strategy, and then generate initial results. Once you've laid that groundwork, funding can act as the oven that helps you fully bake your vision. Next, you don't want to seek funding when you don't need it. Now, it might sound silly, like why would you apply for funding if you actually don't need it? But here's a secret. Lenders love borrowers who don't need their money. It's crazy the banks want to give you credit when it looks like you can get by without it. Lenders love borrowers who don't seem to need their money because it screams low risk. It's like offering someone an umbrella on a sunny day. They might not need it now, but lenders know they'll handle it responsibly if clouds roll in. When you don't need the money, you tend to have lower credit utilization. Your balances are low because you're not relying on credit to float your business. And you typically have low debt to income ratios. Without heavy debt weighing you down, your DTI is in a sweet spot. Lenders see you as financially stable and capable of taking on more responsibility without any strain. This often translates into higher approvals and lower interest rates. And you typically have stronger cash flow. With consistent cash coming in, you're not just surviving, you're growing. A steady income stream reassures lenders that you can handle repayments without breaking a sweat. And you also typically have higher FICO scores. With everything in check, low utilization, low debt, and great cash flow, your personal and business credit scores are likely to be at their peak. A higher score not only opens doors, but also gets you the best terms possible, saving you money in the long run. Now, imagine you wait to apply for funding until you're in a tight spot. Your cash flow has dipped, credit utilization is creeping up, and suddenly your FICO score isn't looking so hot. Lenders now see red flags on you. You're a higher risk, your borrowing options shrink. The funding you do qualify for comes with higher rates and stricter terms. It's like trying to buy a winter coat in January. The selection is limited and prices are sky high. What you really want to do is borrow early. Think of funding as a safety net for the future. When you secure a line of credit or a high limit business card during good times, you're preparing for the unexpected. Whether it's seizing a growth opportunity or weathering an unexpected challenge, that financial cushion will be there when you need it most. Now, if you're ready to secure your own business funding without the guesswork and jumping around the internet for months and taking unnecessary hits to your credit report, and you want to learn a tested, repeatable system that can get you $50,000+ in business funding without proof of income, then you got to check out the next video. You'll learn how to skyrocket your approval odds, max out your credit limits across multiple banks, create a personalized game plan that's tailor-made for your unique situation. You can wipe away your hard inquiries fast, spot and fix every weakness in your credit profile, structure your business to appeal to lenders, master the art of credit applications, overcome credit challenges like thin profiles, know exactly what to do if your application is pending, research baked data points like a complete pro, and find your next funding partner fast. So head over to the next video here to learn more about it, and thank you for watching.